Welcome back. All week long here on Fast Money, we're taking a look at the retail revolution 1 year later. Friday, marking 1 year since Robinhood restricted trades on a handful of popular retail stocks, sending shockwaves across the market. Just moments ago, Robinhood put out a statement detailing the steps it is taking to never let it happen again. Robinhood says it now has a net capital position of $2.7 billion. That, it says, is 25 times what is required by the SEC and roughly the same size as Merrill Lynch's reserves. The company also details ways it has fortified its technology to cope with increased volatility, doubled its customer service support team. The company making improvements over the past year, but the stock, not so much. It is down more than 60% since then. Tim, you are an owner. What do you see in this?
Well, I'm not an owner. I have owned options, and
apologies.
I have played around in this stock in the last. It's okay. And look, my argument was that I see a very sticky client base that, despite the frustrations of a year ago or so, I think you've got a lot of the same group of very, very loyal and a demographic that's highly valuable that a lot of the other both traditional and fintech banks and brokers want a piece of. Having said that, what's the moat around their business? I think that's the big question. The profitability, especially in a world where even during a much stronger crypto and blockchain market than this, they really saw decelerating revenue. So I think this is a statement to try to, again, reassure investors, but reassure the customer base that the company's prepared and has learned to deal with the dynamics that were, look, a dislocation in the market that at that day a lot of people were caught off sides on. But look, notable how they froze people out of markets that they wanted to trade. And that's not something a lot of people are going to forget.
Yeah. Let's turn out to AMC. It is reportedly looking to refinance a lot of its debt. New reports today that the theater chain is looking to restructure more than $5 billion in debt on its balance sheet. Some of that due starting next year. Here to break down what this could mean for the company is Chris White, CEO of BondClick. Chris, great to have you with us. I'm sure a lot of companies out there are going to be watching this very carefully. A lot of companies borrowed their way through tough times, are paying, nosebleed interest rates, and now AMC is doing it. What are they looking for? How important could this deal be?
I think this deal is huge for setting a benchmark in the marketplace. Truly, borrowing conditions are going to change in 2022. I think everyone's anticipating that. And it's a much different environment than what companies like AMC have seen over the past 2 years, where they've had Fed support and low rates. But now the Fed's focused on really stamping down inflation. And I think what we're looking for here is what's the new normal in terms of a below investment grade company being able to access debt capital.
Hey, it's Karen. Thanks for being on. So when you look at their debt, they got a lot to choose from, right? And they've got a lot of high coupon debt. Are they just going to start with the highest? Can they call that? Or what's the strategy here?
Actually, Karen, when we took a deeper look at this on using our, sort of the data that we have at BondClick, I was actually quite surprised. About $5.2 billion is due to mature in 2026. So it might have you, and really there's about $1 billion that's going to be maturing before then. So it kind of have you asking, why try to refinance now? And I actually think that shows that maybe what AMC is looking at is they're looking at really tough borrowing conditions ahead. So they're trying to get in front of it before everyone else realizes that, the tune has really changed and that you're going to have to not only borrow at much higher interest rates, but with a longer maturity, which could spell disaster for a few of these companies out here.
So is that what you think is going to happen, Chris, that there's going to be a very small window for these companies to refinance their debt?
Well, I think the most interesting thing going on is, you don't just turn off a light switch on quantitative easing and all of a sudden the market goes back to normal. There is a ton of cash in the sidelines. And I think what the real question is with the people who are holding cash, when will they get antsy? Because they're going to see a deal that they haven't seen in a while when AMC does come to market. Is that deal going to be oversubscribed, indicating that AMC can actually borrow money at cheaper interest rates or at lower interest rates? Or is AMC going to have to offer more incentives to get borrowers to come in and actually give them the capital? One thing to keep in mind, though, back in October of 2020, the AMC 26s, the second lien paper, was trading at around 15 cents in the dollar. Today, it's at about 94 cents in the dollar. So, while we're worried about AMC, I think things were much more grave looking back a little over 2 years ago, or a year and a half ago.
Yeah, very different picture. Chris, always great to speak with you. Thank you.
Thank you.
Chris White of BondClick. Tim, what do you make? I mean, this Adam Aron has already said that this was one of his goals of this year, to refinance some of its very heavy. I mean, some of these interest rates are like 11%.
Well, look, it's a good time to do it. They've got a little momentum coming off of Spider-Man and whatnot, and at least a bit of a seasonal box office that was extraordinary. But again, that chart we just posted, and Chris has nailed this. I mean, like 27 times debt to EBITDA on a forward basis. I mean, it ultimately comes down to credit metrics, not meme stocks. And I think this is where, I think the debt markets are going to be a lot more ruthless. And it doesn't mean that there isn't a price for debt. And if you look at, even high yield markets, which have been, record tight in terms of spreads, have started to give some ground. If this is about getting in front of it, it's very smart. But again, it's going to come down to credit metrics, and a company who pre-pandemic, was somewhere around 770 million in the best of markets in terms of their top line. So I think it's something investors really have to watch out for.